Whatever income you may have, you can begin to invest. Nowadays, it's easier than ever before. In crypto, you can buy any fraction of an asset, such as Bitcoin, even less than a penny's worth if you wanted to. Most exchanges charge a progressive percentage-based fee rather than a flat one, which makes this even easier. All form of investment comes down to risk versus reward. No pain, no gain. Even when we invest in ourselves, for instance by going to class or watching this video, we are making this calculation. Investments in ourselves require us to spend our time. Time is a scarce, valuable resource to us, so when we spend it, we are implicitly accepting the trade-off between the time we spend and what we get out of the activity. When you take a class, one that you're taking by choice anyway, rather than one you're being made to take, the risk is that the time and effort we put into the class will be wasted. On the other hand, the reward is what we have to gain if we are able to learn from the class and put it to use. I think learning is one of the best investments you can make. When we invest in the markets, we are dealing with another scarce resource, our money. We have to decide whether the risk that the investment doesn't pay off is overcome by the reward from its being successful. Investing in crypto is no different. In order to figure out how much risk we're willing to take, we need to ask ourselves one very important question and think carefully about the answer. That is, when will we need this money again? If we know we want or need to make a large purchase of something in the future, maybe a house or a car for instance, we have to make sure we have the money available to do that, which would mean taking less risk in what we put that money in for the meantime. This is what's known as your time horizon. Time horizon is defined by personal preference, but it is usually informed by age as well. Specifically, the amount of remaining years where you're able to work for your income. If you're just entering the job market or are a young professional, you know you can likely continue to work for money for a while before you expect to retire. So this allows you to take on more risk, so long as you don't bet anything you can't afford to lose. The other element of risk is one's personal preference for the concept of uncertainty. Risk in any investment is underlied by uncertainty. We don't know what's going to happen next. Uncertainty is also tied to time. The longer the time horizon for the investment, the more potential unknown things could happen over that period of time. When you make an investment, you are declaring that you accept the uncertainty with regard to the eventual outcome, whatever level that might be. So it is extremely important that you are actually comfortable with it, because we don't want to put ourselves in a position where we can't stick to our investment plan. Having a good understanding of ourselves in this way is important to know what we should invest in. After all, different types of investments have different risk profiles and thus are suited to different people. If you have the wrong investment, it is going to be very hard for you to act rationally through the market and even harder to reach your goals. Everyone is different. There is no one-size-fits-all approach to investing. Some people are comfortable not checking their investments for days, going on about their lives and sticking to a simple plan of staying invested that can often work great. And it's really all that's needed in most cases. Some people check their investments incessantly. Maybe they just enjoy it, or maybe they are really fighting the constant tug of euphoria versus worry, doubt, and fear. But they manage to stay in control and still stick to their plan. And then some people fit into the above category, but they are not able to stay in control. They do not follow their plan, and at that point, they are no longer investing, they are gambling. It is okay to be in category 1 or category 2. It's not okay to be in category 3. The interesting thing is that people generally can fall into any of these 3 categories, but who they end up becoming has to do with the situation that they put themselves in. Specifically, their ability to do what we talked about and accurately assess their own risk. Let's take an example. Sheila works in the service industry and moonlights as a freelance artist. She has $10,000 in savings. If she were to invest, say, $500 into Bitcoin, she may not worry about it at all and would find it easy to stick to her plan. If she invests $2,000, she might check the price more frequently, and perhaps she'd feel an urge to sell to lock in profits or cut losses at certain periods of time, especially if either her losses or profits become really significant. But if she accepts this risk, she should still be able to stick to her plan. If she invests $8,000, this is perhaps a bit of a breaking point. Since this is most of her savings, she may well be glued to her phone with every price update. If she isn't fully comfortable with this level of risk, this could lead her to become more emotional and make it very difficult to stick to her plan. The most common and most preventable mistake that investors of all skill levels make is acting on emotion. This is something that I know from personal experience, trust me. We see from this example that risk tolerance can be fluid. How easy or how hard it is to accept the risk of an investment is necessarily related to how much we put in. If we put in too much for us, we are setting ourselves up for some real mental stress that may well make it harder to execute our plan. Also, we don't want to live with stress. So, to summarize, we know we have to think about our time horizon and the level of risk tolerance that will allow us to be in Category 1 or Category 2 of investors who can follow their plan. It's no different in crypto, and in subsequent videos we're going to review exactly how we make these investment plans for crypto assets. But first, we're going to need to build a bit more of a foundation. So in the next video, we're going to review the extremely important first principles of investing and how we can apply them to crypto. We're also going to learn more about the different types of crypto assets themselves. Then we'll be ready to architect our crypto investment plan.